Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. And I have some exciting news for everyone today, because for the next few weeks, we're going to be doing something a little bit different with the show, putting a pause on the ongoing Becoming Buffett series we've been doing on the podcast, because on June 27th and 28th of 2017, just a few weeks from now, we're going to be having our mid-year DIY investing summit in partnership with Seeking Alpha. And it's going to be an exciting summit. We're going to have a lot of some of my favorite investors from Seeking Alpha are going to be a part of this summit, and we're going to have all kinds of topics, everything from what their favorite picks are, specific favorite investments are going forward from here, how they're shaping their portfolio for the second half of 2017, how they're hedging their portfolio in light of markets being at all-time highs, as well as how they go about identifying major trends and how do they identify companies to invest in, how do they research them, how do they make buy and sell decisions, all that stuff and more. So I hope you enjoy this preview of the DIY Investing Summit, and you can register for the summit for free at DIYinvestingsummit.com. That's DIYinvestingsummit.com for your free registration. Well, hey, Brad, welcome back to the DIY Investing Summit.
No, it's great to be back again. Thanks so much.
If you could put money in one specific stock right now, what would you say you're most excited about?
Well, that's a tough one. Again, it's hard to recommend one, but I get that question a lot.
I bet you do.
And I hate to default and say Realty Income, because I know everybody listening, and they're going to probably say, "Hey, it's Realty Income," and I don't think it's fair to throw that name out there a lot, but I will say there's certainly one of those on the list. Again, just because of the very predictable nature of the business model. But also, when you look at Realty Income, and really at a higher level, just look at the net lease market today, there aren't really any other sectors that you could say has such ability to scale and grow than net lease. And Realty Income is in the best position to benefit from the consolidation. And I often refer to the net lease space as the banking model, because really, when you think about it, net lease REITs are really banks, disguised as REITs, who lend money to corporate, corporate businesses, and in the form of sale leasebacks. And so, we saw a transaction that closed a quarter ago with 7-Eleven. Sold some of their stores to Realty Income, and to offload those 7-Eleven offloaded those assets off their balance sheet and converted those to leases. It was a smart move for Realty Income to lock in their capital over a long period, probably 20-year leases, I think they were, with options. So 7-Eleven locked in their capital over a long period of time at a very low cost, kind of isolating them from the rising rate environment. And Realty Income made a great buy because the acquisition was accretive. It produced profits. And because of Realty Income's low cost of capital advantage, the company was able to make that transaction work for investors. I think you're going to see more of those types of deals out there in the marketplace. And I think that's going to allow Realty Income to really differentiate itself amongst all of the peers in the net lease space, because it has that low cost of capital. It can go out and acquire very high quality properties, and with a nice spread or profit margin, which obviously translates to increased dividends. So, Realty Income is probably what everybody was suggesting that I would say, but I also say, putting on my value investor hat, I really believe that, Tanger factory outlets I referred to earlier, the outlet space is a tricky space to understand. There are really no other direct competitors in the REIT space with Tanger. They're the only pure play outlet center REIT. And so, I think that a lot of the analysts really don't quite get the Tanger story, because they're focusing on the big malls, which have exposure to JCPenney's and Sears and all the department stores, whereas Tanger has no exposure to those companies. So I think there's really some mispricing, fairly significant mispricing here with Tanger. Interesting fact, Warren Buffett used to own Tanger today. Tanger, Buffett does not own Tanger now. Buffett owns shares in Seritage, ticker SRG, which is the Sears, REIT, the spinoff from Sears. I would argue that Buffett should be buying Tanger today and not Seritage. The real bargain, the real value today is Tanger Factory Outlets.
Awesome. And let me jump back to Realty Income for just a minute, because you started to explain what a net lease REIT is, which I really appreciate, because we've talked about them a fair amount in this interview, but we've kind of been operating under the assumption that everyone knows what that means, when not everyone may be, they may be a little bit newer to REITs. Do you mind just briefly explaining again a net lease REIT, just for clarity's sake?
Sure. Well, I like to use the analogy, instead of the three ends, which a net lease is three ends. It's net, net, net. But I always like to use the analogy, instead of the three ends, the three T's, which are toilets, trash.
Oh, the three T's. Okay, right.
Three T's. Yeah, three T's are toilets, trash, and taxes. And what I'm saying in the very simple terms is that a landlord who owns a net lease property does not have to pay the expenses that are for the taxes and the insurance and the maintenance, and not the toilets. That perhaps is part of maintenance, but the revenue stream, the landlord, essentially a bond-like revenue stream. In other words, there are just, I used to build stores for Walgreens, for example. And when I would collect a rent check from Walgreens, which would be somewhere, say, $25,000 to $30,000 per month, out of that, say, $30,000 per month, I didn't pay taxes. I didn't pay insurance. That's property taxes. I didn't pay the property insurance. I didn't pay for the parking lot repairs. Walgreens paid for that. So all of those costs were paid by the tenant, not the landlord. So it makes these assets very bond-like, not to be confused with a bond, because most of these net lease tenants do pay rental increases. Do pay increase every 5 to 10 years, but the quality of that income stream is much more predictable, sustainable, and reliable, and that's what's really made this space such an attractive space, especially for who are really counting on that income to pay monthly bills or live the lifestyle that used to be living. So net lease has definitely been kind of the bond equivalent in the REIT space.
Well, I hope you enjoyed this brief interview preview from the DIY Investing Summit. And if you enjoyed anything about this and found any value in it, I assure you will thoroughly enjoy the full interview. And you can register for free at DIYinvestingsummit.com. That's DIYinvestingsummit.com. And free registration, and then the summit goes live on June 27th. And so look forward to seeing you there. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.